One chart I saw, and we'll put it up right now, is what happens to the trade deficit. There's a nominal trade deficit we've been reporting, which the president has been complaining about vociferously, and that's that white line down there. It goes down below the zero, goes down to like $500 billion a year, roughly. I understand that, in fact, this might get automatically changed without any money really changing because of how they book the profits under the new system, so it goes up to like $200 billion. So he's more than cut it in half. How does that work?
Well, one of the big problems we have here is that U.S. companies, which are global companies, have lots of opportunities to keep their overseas earnings overseas. They can pay zero tax on that earnings as long as they never bring it back. So they book economic activities like, for instance, Apple booking its patent revenue in Ireland rather than in the U.S., and that makes it look like value creation is happening in Ireland when in fact it's U.S. value creation. So by changing the tax incentives to move production overseas or to credit your earnings from overseas, we'll have a stronger GDP in the margin here. So that's an important effect. A lot of economists believe that U.S. productivity and GDP has actually suffered in recent years because the reporting mechanism, the tax returns, are distorted by companies that are moving their profits overseas and reporting them as being non-U.S. profits for tax reasons.
Well, one way to put it is that it's been hampered, GDP growth has been hampered. Another way is to say it's just been misreported, that in fact it's been better than what we've said it has been because of these bookkeeping things. But are there real-world behavioral changes that will be triggered by this new approach between U.S. versus foreign activities?
Yeah, one of the things you see right away is that investment in the U.S. is suddenly much more attractive because the after-tax rate of return on capital is higher under the new tax regime. So there's just been a major economic study in Germany that finds that the U.S. is now competitive with Europe as an investment destination. So a lot of capital that was pointedly invested outside the U.S. for tax reasons is now coming back here. And what that means is higher productivity, higher wages, and probably greater exports from the U.S. Yeah. Also, because we're adopting a territorial tax system, companies have a real advantage in exporting products from the U.S. because those U.S. sales will not be considered part of their U.S. taxable income.